Hi everybody, welcome to another update on the stock screener. I wanted to give an outlook on oil and gas and why we are invested in this sector. So this is the current status. We see that we had a bull run up until June, and then from here on out we got the SPR release started, and that has pushed the oil price and with the gas price down again. But coal is still very stable. And in the EU, we still have a bull market in gas. So it's a bit mixed. We have bear markets and bull markets, but I think that soon this oil price will start rising again. And there is still an arbitrage to be made between US gas and EU gas. So these are my points, all bull cases, and we're going to go over every single one of them. First one, incentive price. We know that OPEC and the Saudis want a $90 price for oil because that is the incentive price to encourage more investment and capex. We are currently at 70, so we should be going to 90. And that's also seen here. Fair value price is below zero. So this should go back to the fair value price at some point, and that's 90. Okay, that's the first point. Demand is actually very stable. We are at the same demand for oil as in 2019. So this is only US, but there's no demand destruction yet. And this is the demand destruction in the COVID year. So based on this chart, everything seems to be fine. On the supply side, we see that decline rates are steepening. So it's very difficult to keep production up. More and more drilling is needed. So we had a shale boom and now it's going to flatten out. You can also see that here oil production is flat while gas production is still rising. So this tells us that the oil wells are at the end of their life cycle because they are getting more gassier. So at some point this will not go up anymore and this will probably collapse because the shale gas boom is over. We also need to look at the cycles. The nanocycle tells us that we are at a bottom, both in natural gas, and this is going to bottom somewhere in January, February. Oil is going to bottom on 16th of December, which is next week. So the cycle is going up again in a few weeks, months from now. Same with the COT report. We had an up cycle. So this is down, then back to up, then back to down, then up. And here we have an exception because of COVID. Then a down cycle actually. So this is still going up, but on a down cycle. And now we are going back into an up cycle. So I expect oil to go up. Natural gas consumption is going to go up. So this is the US natural gas consumption. It's in an uptrend. And China is definitely in an uptrend because they use less gas than Europe and United States, and they have more people. So this is going to keep on rising in the coming years and even rise more than the United States because they have more people, like 3 times more people than the United States. So I expect this to continue to go up. So this is a very good sector to be in. Rig counts are dropping. And there are multiple reasons for this, because the price is too low, so the price needs to go up. Otherwise, these companies are just going to buy back shares and not invest anymore. And also because the oil companies themselves have very low valuations, PEs of 2 times cash flow, 3 times cash flow. That's very cheap. So instead of investing in more drilling, they are just going to buy back their cheap shares. It's as simple as that. So the oil sector will need to go up in valuation multiples. Otherwise, they will just buy back shares. It's as simple as that. That's why I think energy companies are the place to be right now. They are very cheap. And you can see that here. Drill rigs are actually going back down. So look at this space. If this keeps on dropping, then there won't be a lot of production in the future, because also those wells are declining, right? Now the DUC wells are also gone. So what is a DUC well? That's a drilled and uncompleted well. So those are wells that have been drilled but are not producing yet. So a lot of wells have been drilled out but not producing yet. They are now coming back online in the last 2 years. Now it is flattened out. So all the production that can come online very fast has already gone in production now, and none are being added. This will not drop anymore. This has been flattened out here because these are bad wells. So the savings account for oil and gas has been emptied now. No more extra production coming online. Capex to sales ratio is still at a very low level. So as capex is low, prices are low, then the price increases, and then oil companies will increase their capex to drill more, because the high price incentivizes more capex spending. Now we are in a decline, so no more capex anymore, and that coincides with this decline here in the price, because the price is too low, so they won't invest in capex anymore. So to get this back up to this level, the price needs to go up again. Otherwise, there's no extra capex anymore. Okay, so based on this chart alone, we know that we had an up cycle, down cycle, and now we should go back in an up cycle in the coming years. So oil prices should go up again, not down. Now over to EU gas flows. So this is a chart of the EU gas flows currently. We had Russia, LNG, Norway, and then some other UK and North Africa. You can see that the gas imports to Europe are declining, mostly coming from Russia. That's now at almost zero. This is not going to come back. Yeah, it's over. Okay, it's over. This will stay at zero, and the LNG is the new place to be. So LNG imports have risen from here to this level, which is all-time high. And this is going to keep on increasing. This is a new business. And this should go back to at least this level. So a lot of LNG will come in here. So that's the place to be. Invest in LNG companies. And of course, LNG comes from US gas. So that's why we invest in US gas and Canadian gas. And this also tells us that EU gas prices will stay high, because the gas flows are very low at this moment. Russian gas production is down. So this is the latest data. It's below average. So where is the gas coming from? From LNG. So let's talk a bit about LNG. So these are the costs to build LNG plants. That's dollars per ton per annum of LNG. And those costs are actually very okay at 500. So let's take 800. That's about $16 per MCF per year. Now, I have done some napkin calculation on this. Gas cost is $5 per MCF. Operating cost, I think, is 3, transport 1. So it gives around 10 MCF. And the current price is 35, as you can see here, $35 per MCF, which is higher than previously. So they have upped the estimate on LNG. So that gives us a margin of $26 per MCF. That's 35 minus 9. And that is a very good margin, right? Because the build cost is only 16 and you get 26 per year. So it's a profitable business. So I expect LNG to be the place to be. And that means that US gas demand will rise. Also, Freeport LNG is coming online by the end of this month. We already see some flows here. So this is the first flow that we see from Freeport. So this is Freeport. This is offline and will come back online next month. And even this month we see flows. So this is going to be a positive for US gas and also Canadian gas. Not only Freeport will come online, it's also Canada that will build an LNG facility called LNG Canada, which is located here, and they will be shipping out to Asia. That's about 3.5 BCF per day. If you look at this chart, that's a huge amount, 3.5, and that will increase the capacity very bigly. So we won't see any pipeline constraints anymore in Canada when this comes online, and that's in 2025. We are a bit early, but it's good to be early because this is a catalyst for Canadian gas. Winter is coming, both in EU and USA. In the EU, we already see a huge increase in the natural gas flows. It's spiking, and I hope that it will spike above this trend, this maximum trend. So gas withdrawals are already starting. In the US, we had a very mild weather up until 9th of December. Now we are going to get much colder again. So I expect US gas to rise because of the cold weather coming. Then we have the tanker jam. Due to the Russia oil price cap and insurance problems with the tankers, we are seeing a jam in Turkey and probably everywhere in the world because of these insurance problems. And tanker rates are soaring. So this should actually benefit tanker rates because there is not enough tankers. They are all stuck and rates will probably keep on rising. So we are also invested in the tankers. But due to these jams, oil is now stuck. So the supply is going to be lower and that will increase the oil price. US dollar is falling. So this is the US dollar index. The long positions are now starting to unwind and the US dollar is starting to fall. So we are in a bear market in US dollar. that means that oil will probably go up because the US dollar is falling. And here the yuan, the renminbi, is rising again. So that is positive for the oil price. We haven't seen it yet, but I think that a weakening dollar should be good for the oil price. Also, China is now reopening. So credit impulse is up, and that means they will buy more oil. So watch this space. China airplane flights should be rising now. If that happens, then oil will start rising. And China also said that they would buy more oil from the Middle East. That was from 9th of December. Global oil inventories are dropping. So this is from Eric Nuttall. When inventories drop, it's easy. Demand is higher than supply. So as this keeps on dropping, oil should be going up. Also, there's too much bearish sentiment right now. This bearish sentiment will eventually go back bullish. And whenever you see a bearish sentiment, oil starts to rise again. This is oil. So bearish, it will go up. This is natural gas. You can also see here, bearish always goes back up, up. And here we have this bearish sentiment go up. So I expect a bounce at least when this sentiment goes back into bullish sentiment. Then our last chart, this is from Wall Street Courier. And look at energy. It has stayed at 100% for almost 2 months. So this is the place to be in the investment place. So cash has been going to 37%, so that is very low. So it's better to invest your money than be in cash. And the best places right now, and this is the latest data, is in energy, healthcare, even in the industrials. Materials are also improving. What we should avoid is the S&P, which is going down. Technology, utilities are very stable, but not good enough. Financials are worsening. And yeah, the worst thing to invest in is consumer discretionary, like Lululemon, Walmart, those things. Zero. So avoid this and stay in energy. So that was the update. A lot of bullish indicators for oil and gas, and we are going to stay the course and keep investing in this sector. And I'll see you in the next video. Bye.